Most people have heard of BlackRock. It manages trillions of dollars, it appears in headlines, and its influence over global markets is widely discussed. But there is another company just as powerful, a company that almost never appears in the news, a company that quietly sits behind enormous portions of the global stock market. That company is Vanguard. And in many ways, Vanguard is even more unusual than BlackRock, because the structure of Vanguard is unlike any other financial institution on Earth. Most corporations have shareholders. Investors own stock in the company. Those shareholders elect executives, and the company operates to generate profits for them. But Vanguard works differently. Vanguard does not have traditional owners. Instead, the company is owned by its own funds, and those funds are owned by the investors who buy them, which means something remarkable. The investors who place their savings into Vanguard funds indirectly own Vanguard itself. It is a structure that sounds simple, but its implications are enormous, because Vanguard manages trillions of dollars in assets. And those funds hold shares in thousands of companies across the global economy: Apple, Microsoft, Amazon, Google, banks, energy companies, pharmaceutical giants. Across the corporate world, Vanguard appears again and again as a major shareholder. Yet, unlike traditional investment firms, Vanguard does not exist primarily to generate profits for outside owners. Instead, its structure allows it to operate at extremely low cost. And that idea changed investing forever. But to understand how Vanguard became so powerful, we need to go back to the 1970s, because the story of Vanguard begins with a radical idea that many people once believed would never work. Part 2, the idea that changed investing. The founder of Vanguard was a man named John Bogle. Bogle had spent years working inside the investment industry, and during that time, he noticed something surprising. Most professional fund managers failed to beat the market. They hired analysts, they studied companies, they made complicated investment decisions. Yet over long periods of time, many actively managed funds actually performed worse than the market itself. Why? Because of costs, trading fees, management expenses, commissions. All of these costs slowly ate away at investment returns. Bogle began asking a simple question. What if investors stopped trying to beat the market? What if they simply bought the entire market instead? This idea was revolutionary at the time. Instead of picking individual stocks, investors could buy a fund that tracked a market index. Such a fund would hold hundreds of companies at once. It would require very little trading, and its costs would be extremely low. In 1975, Bogle created Vanguard. Soon after, the company launched one of the first index funds available to individual investors. At first, the idea was ridiculed. Critics called it Bogle's folly. They believed investors would never accept a strategy that simply aimed to match the market instead of beating it. But over time, something unexpected happened. The index fund began performing extremely well, because while active managers were charging high fees, the Vanguard fund kept its costs extremely low. Year after year, those savings compounded, and investors started noticing. Money began flowing into Vanguard funds, then billions, then hundreds of billions, eventually trillions. Index investing transformed the financial industry, and Vanguard became one of the largest asset managers on Earth. But the company's structure made it even more unusual, because Vanguard was not owned by outside shareholders demanding profits. It was owned by its funds, which meant the company could continually lower costs for investors. This created a powerful cycle. Lower fees attracted more investors. More investors increased Vanguard's scale, and greater scale allowed the company to lower fees even further. Over time, Vanguard became one of the largest owners of stocks in the world, not because it was trying to control companies, but because millions of investors were buying its funds. And those funds automatically purchased shares across the entire market, which created something extraordinary, a company that quietly became one of the largest shareholders in thousands of corporations. Today, Vanguard manages trillions of dollars in assets. Its funds hold shares in thousands of companies. Across the global economy, Vanguard frequently appears among the largest shareholders: technology companies, banks, energy corporations, pharmaceutical firms, consumer brands. Vanguard's funds hold pieces of them all. And because index funds track the market itself, the company's influence continues to grow as more investors adopt passive investing. This raises an interesting question. If a few asset managers hold large ownership stakes in thousands of companies, what does that mean for corporate power? Some critics argue that this concentration of ownership creates enormous influence inside the financial system. Because firms like Vanguard, BlackRock, and State Street collectively hold significant stakes in much of the corporate world, others argue that these firms are simply managing investments on behalf of millions of ordinary investors: retirement accounts, pension funds, university endowments, and individual savers. From that perspective, Vanguard is not controlling corporations. It is simply holding shares for the people whose money is invested in its funds. But regardless of how one interprets it, the rise of index investing has changed the structure of global finance. For decades, Investors tried to beat the market. Now trillions of dollars simply follow it. And companies like Vanguard sit at the center of that transformation, quietly managing enormous pools of capital, quietly holding shares in thousands of corporations, quietly shaping the structure of modern financial markets. Which leads to one final realization. BlackRock is not the only giant behind the global financial system. Vanguard stands beside it. And together with a third company called State Street, they form something even more powerful. The three largest asset managers on Earth. A trio often called the Big Three. Together, they hold enormous ownership stakes across the global economy. And understanding their influence reveals something important about the structure of modern finance. Because the real power in markets is not always visible. Sometimes it operates quietly, behind index funds, behind retirement accounts, behind the institutions that manage the world's savings. And once you see that structure, the global financial system begins to look very different.